The broader point is that they shouldn't be cutting rates at all. In fact, not only should they not be cutting rates, they should be raising rates. When it comes to monetary policy and whether you're too loose or too easy is gold. And in fact, Alan Greenspan, who used to be the Fed chairman, when he was asked about it, he said that he uses gold. And at the time, gold was around $350 an ounce when he was answering this question before Congress. And he said, well, if I see the gold price up about 400, I know that I'm too easy. And if the gold price goes below 300, I know that I'm too tight. So he said, we're not officially on a gold standard, but unofficially we are, because I use gold as a guiding light to set policy. So I know if we're too easy or too tight. Well, by that data point, gold's at an all-time record high. Gold's moved up 25% so far this calendar year in anticipation of the Fed cutting rates. Well, what does that tell you? That these rate cuts are a mistake. That is the data point that the Fed should be looking at. Also look at the dollar, which hit a new 2024 low this week. It's now back to where it was in December of 2023. But what's more important is the trajectory. The dollar is falling, and it looks like it could fall substantially. Again, this is the currency market saying you're making a mistake, because the weak dollar in and of itself is going to push up consumer prices because we buy stuff with dollars. America has $1 trillion a year trade deficit. We import all sorts of products that we pay for with dollars. Well, if the dollar goes down, the price of all those products has to go up. So the Fed is about to make the inflation problem worse by claiming that it solved it. Right? So they're actually not cutting rates because they won the inflation war. They're cutting rates because they lost. It's a surrender, because they're looking at the impact that the higher interest rates are having on the economy, on employment, which is something that has to happen, because the low interest rates is the artificial support that boosted the economy. It created based on debt. And so when you raise interest rates, you make that debt that was accumulated when rates are low a big burden on the economy. So there's no way to normalize interest rates without collapsing the artificial economy that was built on top of the cheap money. But now the Fed doesn't want that to collapse, so it has to go back to the cheap money, which means we're going to get a lot more inflation. A lot of more unemployment than the government admits to. A lot of it is the way that it's calculated, because so many people have left the labor force that it really skews the unemployment numbers. And also the way we count the unemployed now is very different. You know, we made a major change in 1994 to the way we figure out who's unemployed. And we took a lot of people that used to count, and we decided that they don't count anymore as unemployed. So that's the real reason the number is so low. In fact, we still report the number that we used to use, but it's beneath the headline, so nobody notices it, but it's called U6. And U6 was the actual only unemployment rate we used up until 1994, when they came up with U3. But what U6 does is it counts people who are unemployed, who want jobs, but they're just not looking anymore because they're discouraged. They've just given up. We don't count them now. You have to be out there looking for a job. And if you're not out there looking, you're not unemployed. Even though you're not working, and even though you'd want to work, the fact that you've given up hope means that you're no longer in the statistics. Then there's another category of people who have a part-time job. Let's say I've got a job and I work, 5 hours a week. But for the rest of the time, I'm looking for a job. But meanwhile, I got this little gig that I got 5 hours a week. They're not counted now as unemployed, because as long as you do 1 hour of work somewhere, even if you spend the other 40 hours a week looking for a better job, you're not counted as unemployed anymore. But in U6, you are. If you look at the U6 number, it's not 4.1. I think it's 7.9. It's pretty high. In fact, I looked back 53 years, but starting after 1941 to 1994, there wasn't a single year of those 53 years where the unemployment rate ended as high as it is right now. So if you want to compare apples to apples, we don't have a low unemployment rate. We have a historically high unemployment rate. And it's going to get a lot higher. Meanwhile, the jobs that have supposedly been created are a myth. The vast majority of the jobs that Biden takes credit for creating were jobs that existed before he was elected. It's just that those jobs were on hold because of COVID. So the companies furloughed their workers because of the COVID lockdowns when Trump was president. Biden comes in, the economy reopens, and the businesses say, okay, everybody come back to work. Biden is calling those jobs that he created, but they were already there, right? Then, if you look at all the new jobs, in addition to those jobs, the restored jobs, that's all a myth because we have fewer people that have full-time jobs now than when Biden was elected. So the jobs that were created under Biden were second and third jobs because Americans could no longer make ends meet. There was so much inflation created that people couldn't get by on one job anymore. So a lot of people had to go out and get a second or a third job. Those are the jobs that are created. But the people who have those jobs would prefer not to have them. They don't want them, they need them because their other job no longer pays the bills. So it's moonlighting, it's an explosion of moonlighting. If you dig deeper, all of the net new jobs went to immigrants, whether they're illegal or legal. They didn't go to people who were born in America, right? They lost jobs. The net gain came to people that moved to America. So that also tells you something. And again, a lot of the jobs are in government, which are only here because we run huge deficits to provide people with government jobs. These are not productive jobs. We don't need these people. They're not producing anything that improves our lives, but we have to pay their salaries with inflation because we end up running higher deficits. So these are non-productive jobs. Then the other jobs are part-time jobs in restaurants, in hotels, in bars. You know, there's some healthcare jobs. We've lost manufacturing jobs. Those are the jobs we need, yet those are the jobs that have been destroyed during the last 3.5 years. Although they were being destroyed even before Biden came around, but we've destroyed even more. So that's why the manufacturing industry has been in a recession for almost the entirety of the Biden presidency. Even by the government's own numbers, manufacturing's in a recession. Now, I think the whole economy is in a recession because I don't believe the numbers. But even if you take the numbers on face value, manufacturing's in a recession. And that's part of the problem with inflation because we're not producing enough stuff. All we're doing is printing money to buy stuff that we don't produce, and so prices go up. And they're about to go up a lot more, once the Fed starts cutting and we start to see the impact on the weak dollar and what that does to commodity prices. The housing market is very different now than in the last bubble because during the last bubble, people had a lot of teaser rates, people did a lot of ARMs, and all those things reset. And so it was very difficult for people to make their mortgage payments. But when real estate prices dropped, even the people that could make their mortgage payments didn't have an incentive to do it because they were just throwing money away. The house that they bought for $500,000 was worth $400,000, so they were negative $100,000 in equity. And why keep sending money to the bank when it's none of it's in your pocket? You could just mail in the keys and go rent something for less money because people were struggling to make their mortgage payments because they thought they were going to get rich on the appreciation. Well, when markets went the other way and they moved out, and so the banks were in trouble. But now it's different. Most people own long-term fixed-rate mortgages at very low rates. Probably most people are in the 3s, and there's a few lucky people that are in the 2s. So people do not want to leave. The price of everything has gone up except their mortgage payment. Their mortgage payment has been fixed. And so their mortgage costs have actually gone down in relation to everything. So people don't want to move out. Even if they want a bigger house or something, they can't leave. They're trapped because they got such a great deal on their mortgage. Now, they're still hurting because their taxes are up, their maintenance is up, their insurance is up. But the one thing that's not up is their mortgage payment. That's the only thing they can control. Rents have gone way up. So people who are renting, they're paying much higher rents. But if you own a home and you had a fixed rate mortgage, so the market is locked. People aren't selling their homes. And the problem for the banks, in 2008, the problem was when people stopped paying their mortgage. The banks were in trouble because they had to sell the house, and it had dropped. So the collateral behind the loan was no good, and they were losing money. They're actually in a much worse position today. The problem with the banks is not that people are defaulting, but that they're staying in their homes and keeping their mortgages, because the banks are losing money on every mortgage they wrote, because they loaned out the money at 3 or 4%, and now they have to borrow that money from the Fed at over 5%. So all these mortgages that were profitable for banks when rates were at zero are now unprofitable. They're losing money, and they're losing a ton of money. Plus, they have to deal with the crisis in the commercial market, which they didn't even have in 2008. So we have a completely insolvent banking system, which is the other reason that the Fed stopped hiking rates. In fact, it's not a coincidence that the rate hike stopped when banks started to fail, right? That's when they stopped. They hiked rates until the markets broke, and then they backed off. But they're going to cut because they're trying to prop up the banking system. They're trying to prop up the government. Based on the most recent numbers, 25% of tax revenue now goes to interest on the national debt. Interest on the national debt is now more expensive than defense. It's the third biggest expense the government has behind Social Security and Medicare. And in another year or two, it's going to exceed Social Security and Medicare. So the Fed is trying to do something to ease that burden. And what can they do? Lower rates so that it's not as expensive for the government to finance its existing debt or to finance new debt, because our debt is rising by $3-4 trillion a year. Just look at the national debt. You look at how rapidly it's going up. So this is why rates are being cut. It's not because the Fed won on inflation. Inflation won. Of course, the Fed created the inflation, and now they're going to create a lot more.